Hey, welcome to this episode of The Complete Advisor. We have a very timely treat for you. We are going to dive into kind of the big picture, what you need to be doing now when it comes, as it relates to legislation, as it relates to the current political environment. Usually I like to shy away from political conversations in my professional and personal life. But we need to know these things. As financial advisors, we need to know what's going on. And my gosh, right now, there is so much going on. So we are recording this today. Is today the last day of February?
Last day
of February. It is the last day of February. So so when you see this, when this goes out, I will put this out on Monday the 3rd of March.
I can't do math.
Me either. So it'll be right away. So when you see this, this is a very timely episode. So it'll be right real time action.
Yeah.
So. With that being said, I would like to introduce our guest. She's been on the show multiple times. Becky Swansburg. Becky, welcome.
Thanks for having me, and thanks to Washington for always giving us something new to discuss.
You know what? That's the beauty. I think that's one of the beauties of our industry is that, as we go through this thing called life, being able to adapt to change is so crucial. And the fact that in our industry, as things change, well, you know what, we can't necessarily affect change, but we have to adapt to it and we have to guide our clients through it. And there's always going to be change.
Always.
So we're always going to be needed.
It's the one thing we guarantee about Washington. Every 2 years, new government.
Absolutely. Okay, let's do this.
Yeah.
So there's a chance that there are people listening or watching this podcast that don't know who you are. You've been on here an awful lot of times, which is awesome. But could you give your quick bona fides, and then we'll just jump right into the topics.
Absolutely. Well, like so many people in our industry, my first career was not in finance. It was actually in government and politics. So I worked in the White House under George W. Bush's administration, and then on Capitol Hill for the Speaker of the House and a couple different members of Congress, which really lit this passion in me, helping U.S. savers and the advisors that serve them just really understand what's happening in Washington and how it could impact their retirement approach and what we need to do to prepare.
Love it. Okay, so you've got the bona fides, you've got the chops. Becky has been on stage for us, for multiple people across the industry. You are just a brilliant, brilliant woman. So awesome.
No pressure.
No pressure. All right, let's dive in. So right now, you haven't seen these questions. We'll rapid fire them because we've got kind of a block time here. But okay, so Trump is back. Mm-hmm. Congress is split.
Yep.
Debt's out of control. So what's the real story right now? Because there's so much, so fast, fire hosing. What should financial advisors be paying attention to?
I think right now all eyes are on, do the Tax Cuts and Jobs Act, those Trump tax cuts, get extended?
Yeah.
So if you remember when Congress and the president passed that during Trump's first administration in 2017, the tax cuts were not permanent. They actually expire at the end of this year in 2025.
So it's the 2025 tax year. So next spring when you're doing your taxes, that's it.
That's it. This is our last year as it stands with these kind of artificially low tax bracket rates. And for what it's worth, for like middle class, everyday average American savers, tax bracket rates are about 30% lower than they were before the reform. So a big bump could be coming next year unless the President, House, and Senate all get together and pass an extension. So it's interesting, Dennis, if we were sitting here last year and you said, oh, what are the chances that the Trump tax cuts get extended? And I said, well, pretty small because we have to have President Trump reelected and the House and the Senate both under Republican control. Uh-huh. And lo and behold, here we are, February 2025, and that has occurred. So the challenge is that the House and Senate are both very narrow margins for their Republican control.
Very narrow. Yeah.
They've got maybe 3 seats in each house. So that means we cannot have any defectors if they want this bill to go through, because there aren't Democrats that are going to come and give Trump this victory. Yeah. So right now, the president, the House, and Senate leaderships all agree, let's extend the tax cuts. They don't quite agree on how. So the Senate would like to do it in a phase 2. The House would like to do it immediately. They're working that out. Crystal ball, do I think they will get an extension passed? I do. I think it is a signature initiative for the president. We're just going to have to wait and see what gets horse traded around to make it happen.
Do you think it'll be permanent or just a short term?
I think there's very little chance of it being permanent. The House Conservative Caucus has already said that they will not vote for anything past a 5-year extension. So I suspect the extension will be 5, maybe at the outer reaches 8 years, most likely closer to 5. They're expensive. They're not expensive for our clients who get more money in their pocket, but it's a lot of lost revenue to the government in the trillions of dollars over the next decade. So I think we probably can expect to see maybe another 5 years of these low bracket rates, but we will see.
So you don't think that Doge is going to drop is going to cut enough to not have to worry about it?
I mean, I would love for them to do that, but right now, if you look the past 10 years, we've run between a $1.5 and $2 trillion deficit every single year.
Yeah.
So it's still a lot of money that's going to have to get cut out of government spending. And in theory, that seems like, oh, it's not a big problem. But you think, how are you got Medicare, Medicaid, Social Security, and defense spending. That eats up probably 3/4 of all government spending.
Yeah.
So there's just not that much room to really cut to the bone.
No, yeah. There's just so much that has to get paid for.
Yeah.
Were you surprised? So let's back up just a second. So the last time we were on it was way before the election. Biden was still, when the last episode that we did together, Biden was still in the running, which is funny because I look at what podcasts are being like listened to and watched, and people are still watching the Trump or Biden elections have consequences. It's like, hey guys,
the consequences are here.
Yeah, it's here now. Were you surprised?
I was not surprised. I did think Trump would come out on top. I was thinking we might have a little larger House and Senate victories for the Republicans, but that's one of the reasons why they've really got to get moving, because what traditionally happens in midterm elections, the majority party loses House and Senate seats, the margin is already very thin, and they start electioning for that election. They start campaigning in January. So really we have till the end of this year to get something moving on these taxes. Now, what does that mean for financial advisors? One thing that I've found is interesting from both, I hear it from advisors and from their clients. For a certain set of clients, there's kind of this feeling like, hey, we don't have to worry about rising taxes anymore. Like Trump's going to fix it, Doge is going to fix it, we're okay.
So how do you get them off the side?
What I love to look at a client or a saver and just say, look, if you only plan to be retired for the next 4 years, we don't have to do a thing. Let's just let this ride out.
Nice.
But I suspect that you, like me, plan to be retired for the next 10, 20, 30, or even 40 years in the future, which means we have to see the next 4 years as a gift. Now, we know for certain tax rates are at these lower rates in 2025. Yep. I'm hopeful we'll get a couple more years. But we got to leverage these next 4 years to plan for what's coming over the next 40. And I think that's really the takeaway message. When you look at the demographics, at the number of U.S. citizens needing Medicare and Social Security in the years ahead, it's going to be hard to dramatically shrink government over the long term. Anything Doge puts into place today, the next administration can just undo in 4 years. So I think the key is let's use these lower tax rates today to really plan for what's coming. Let's use this four to plan for the next 40.
I like what you said so much there. You always come up with such great phrases. A gift of 4 years. That is fantastic. Yeah. So I mean, like if Congress is not going to touch Social Security. Congress is not going to touch Medicare. So if they need more money, where's it come from?
Yeah.
It's got to come from there. Okay, so let's talk a little bit about. I'm looking at some of my notes here. Some revenue tricks.
Yeah, revenue tricks.
Let's talk about that.
That's actually a perfect jumping off point from your last comment, because all eyes are on the Trump tax cuts and what's going on with tax brackets. But man, tax brackets are only one way that the government can change how much revenue they take from us, like how much they generate. And I like to say, most of our clients don't actually care about their tax bracket, about their tax status. What they care about is when I take $1 out of my IRA or 401k in retirement, how much goes into my bank account and how much goes back to Washington. That's right. I think we are entering an era of creative revenue tricks coming out of Washington. And it's interesting, there's a lot of ways that Congress can change the rules without ever touching your brackets. And we actually just saw one of these in 2019 in the Secure Act, which I know was a very large bill, but one thing in the Secure Act that Congress did was eliminate, for most savers, the stretch IRA. So it used to be if I inherited an IRA from my parents, I could take that money out as I needed, and in that way I could kind of manage my tax responsibilities.
Yep.
But now Congress changed the rules, and if I inherit an IRA from my parents, I by and large have to drain that account in 10 years, whether or not it puts me in a bad tax situation in those 10 years. So it's a great example that Congress didn't change my brackets, but suddenly the way that I thought I was going to be able to manage this money, the rules are changed, and I could end up with a much higher tax bill just from being forced with that income.
Good news, we didn't change your tax brackets. Bad news, we're not letting you do that. So what other things can they do? I know I listened to a talk that you did recently, and I know that one of the things that you mentioned was IRMA.
IRMA, let's talk IRMA.
Walk us through that. Dumb it down, though, for me first.
That's great. If you can't explain it to a third grader, you don't know it, right?
That's right.
So IRMA is a great topic because it's funny, if you're at a seminar or talking with clients, a lot of them, unless they've elected Medicare and been hit with the IRMA surcharge, they don't even know about it. So IRMA is the income-related monthly adjustment amount. Government loves some acronyms. And essentially, when seniors elect their Medicare Part B and Part D coverage, they pay premiums for that coverage. But the most important two words in IRMA are the income-related, the I and the R. Because if you have a certain level of income, the government says on top of your premiums, we're going to charge an additional surcharge. Don't worry, it's not a tax, by the way, Dennis. It's just a surcharge. It's just money we take from you back to the government.
I feel like I'm buying something from Ticketmaster. Ticketmaster, sorry, but that's what it feels like.
It's just like these extra surcharges that they're going to put on. And IRMA surcharges have increased every single year since they have been initiated. And it's just a great example of how the government can generate additional revenue outside of kind of the existing tax code. And let me tell you what's fascinating about IRMA and why I think 2025 has to be the years that financial advisors are helping their clients understand IRMA and do strategies that help mitigate it. You know me, I love boring government reports. I really dig deep into the government reports. And last year in 2024, a subset of the Medicare and Medicaid trustees, they put out a report that looked at the trust funds for all of the U.S. government's different healthcare programs. So for Medicaid and Medicare, these healthcare trust funds. And on Medicare, the report looked at Part A, the hospital coverage, and it is in dire shape. It is going to be out of money. They don't know how to keep it fiscally sound beyond the next 10 years. But then you keep flipping through the report, and it gets to Medicare Part B and Part D trust funds. And the report is like, great news. These trust funds are actually totally solvent for the next 10 years and beyond. And you read that and you're like, that is great news for all of our clients. Until you flip a couple other pages and you realize the reason that the government is saying the Part B and Part D trust funds are solvent is because the government has unlimited ability to raise premiums and IRMA surcharges. And the report says we can raise IRMA surcharges as high as we need to cover any potential gap. So here we have the government kind of deep in this report telling us your IRMA is going to go up. We're going to have higher rates and apply it to more income levels. And it's just, IRMA, a lot of savers choose to have their IRMA just automatically withheld from their Social Security check. And so what this is going to have the effect of doing over time is just reducing the amount of Social Security that seniors actually recognize in their bank account. Because more and more of it's going to be these IRMA charges. And the report acknowledges that. The report says over the next 10 years, a growing portion of most savers' income and Social Security will go to Medicare surcharges and premiums.
Golly,
it's depressing news.
That is actually kind of depressing because it's one of those things. It's when you're young and you get your first job, and you're all excited because you get your pay, and you're like, I'm making blank, but nobody ever says, well, actually, you get your salary, but you need to look at what you actually get to take home. And this, gosh,
who's this FICA guy that's taking all my money?
Who is this? What is this shenanigan?
But I will tell you, that's one of the reasons 2025, I think, is a really critical year for advisors to double down on things like Roth conversions and other kinds of tax-free conversions. One, we know this year the tax rates are artificially low, and we're hopeful for a few more years we'll get them. But we know that that's limited. The other thing is we can help offset IRMA concerns for our clients going forward. One of the things that I think is actually kind of fascinating, When the government calculates IRMA, they calculate it off a special modified adjusted gross income calculation.
Okay.
They do not include income from Roth accounts in that calculation. So
There
if
you
we
go.
can help our clients have some more tax-free funds, whether it's in cash value life insurance or a Roth account, the income coming out of that is not counted towards their IRMA. We can keep their calculations for IRMA lower and hopefully help them either stay in a lower tier or avoid those tiers altogether.
How big of an impact is, how big of a bite is IRMA? I don't know.
You know, it's interesting. Sorry, Mom and Dad, but I asked my parents the other day, like, could you calculate last year, what did you pay in premiums and IRMA surcharges? And it was over $20,000 that year.
Really?
I mean, it is
Get out.
significant. I think when I did the calculation, they pay more for Medicare because they're subject to these IRMA fees than I pay for my private insurance. Now they're getting heck of insurance for it.
Right.
But it's not this kind of, oh, we're going to get this thing for free
Yeah,
that maybe
yeah.
seniors have been led to believe. So I think IRMA is a critical prospecting and marketing message. And when you get the clients in your office, we can say, look, we can not only help you potentially manage IRMA through conversions, but also through the conversion process, we can help you manage to make sure that as we convert funds, we don't trigger higher taxes or higher IRMA during the conversion year. And it's funny, you know, every advisor knows do-it-yourself or Roth people are everywhere.
Yes,
you know,
they are.
people come in, I can do a Roth. It's not a big deal. It's actually a lot more complex than savers realize because you're not just managing taxes. You got to manage IRMA through that conversion too.
Yeah, that sounds like a big deal.
It's a big deal.
What other are there any other revenue tricks we should keep our eye on, like national park memberships? I'm just
Yeah.
joking, but like
I mean, I do think we're going to watch Social Security. You know, Social Security originally, your benefit was not taxable. Under Reagan in the 80s, they voted to make it taxable up to 50%. Clinton in the 90s, the current 85%. And Trump has said he'd like to kind of take that back to zero. But there's
what are the odds of that?
you know, I think I looked, it's not that many billions of dollars of cost. And it's funny
Really?
to say, oh, it's only, you know, $600 billion.
Tanks.
Yeah. But what I think future administration, so I think Social Security is going to probably be okay through this administration. Trump's kind of made it a signature. But we have elections every 2 years, new White House administration every 4 years. And I think where they're going to look in the future is right now there is a cap on how much of your income is taxed for Social Security because there's also a cap on your Social Security benefit. Well, if they remove the cap on taxable income but keep the cap on benefit, if they allow all of your income to be taxed, even though your benefit's limited, that takes us a long way to solving the insolvency problems with the trust fund. So those are other ways that, you know, they're not changing your tax bracket, but if more of your income is subject to taxation, like I said, all clients care about is how much spendable money makes it into their bank account.
I have a random question that popped
Yeah.
into my head. If you're listening, I have like my notes and where I want to take the conversation, and I have these things that pop into
I
my
love
head.
it. Let's see if I can answer.
Has there ever, with your insider knowledge, has there ever been a midterm election that followed the previous presidential election?
Yeah, we
Party-wise?
have had. If
we
you
had?
look over the past maybe 30 years since the 80s, I think it's about a quarter of them do not follow.
Gotcha.
But most of them, about 3/4 of them do, you know, the party in power loses. America, by and large, does not like unified government. And having worked in both a unified government situation on Capitol Hill and a not unified government situation on Capitol Hill, it is hard to keep a party together when you're in power.
Yeah, there's
That
too
is
much
hard work.
bloating and
And just, you know, we have these big tent parties here in America where a lot of different interests are under the Republican or the Democrat tent, and it's just hard to get them all on board.
I think we'd ever see a viable third party, fourth party. Like, you need to see the parliamentary system, and there's
Yeah.
like, you know, we have to talk to the Green Party, and we're bringing Labor on, and we've made this coalition. That probably never happened.
It's going to be hard. I think we're kind of set. And I don't know that it's necessarily a bad thing. I think that the compromises our parties have to make to get everyone on board are probably in the long run good for America. I don't mind that legislation moves a little slow. I don't need anything fast tracking through. Let's have the debate. Let's stop bad stuff from getting through and make sure the good stuff
Yeah,
comes to
let's
the top.
slow it down just a bit. Okay, one last random trivia
Okay.
question. How many other countries?
Let's see if I know.
I'm not holding you to this, but
Right.
this popped into my head. How many other countries? I guess in the industrial.
Mm-hmm.
I don't know what our peer countries.
Yeah.
How many have safety social nets like Social Security? It just popped into my head.
Well, a lot of we kind of modeled some of our social safety net off of the European model.
Yeah.
The European model obviously carries much, much higher tax rates. So I think some of our challenge with Medicare and Social Security solvency is that we want to provide levels of care and levels of benefit, but we do not have the tax base to fund it like they do in Europe.
Yeah.
Europeans look over at us and can't believe how little we pay. Now, maybe they can't believe how little services and benefits we get for it too, but I think that there's not easy solutions to a lot of these problems from the policy side, which is why I think revenue is going to have to go up. We talked about this 4 versus 40, but like retirement is this long-term endeavor. And so we are trying to help our clients prepare for like 10 to 15 election cycles into the future.
Yeah.
And I just think long-term, we are going to have administrations that recognize that I don't want to cut Social Security or Medicare on seniors. I'm going to have to raise more revenue.
Do you think, at what point do you think the time will come when it's like, okay, it's no longer feasible for you to be retired, to expect to have a great retirement income for a period basically as long, or maybe as long as you worked? Like that's not, I don't know how that math works out.
Part of it is, they could over time, and they have raised the Social Security retirement age.
Yeah.
I do think they are going to have to do that. The challenge is the revenue for that gets banked by my generation and your generation, not the generations today. So they've got to wait some time for that revenue to come in. But, it's not just how long we live in retirement. It's also what retirement is.
Yeah.
The greatest generation, I was saying earlier today, like I remember, my grandmother reused her Ziploc bags, washing them out, hanging them on the sink.
Yep.
Yeah. In retirement, they just lived these very small lives where they quit traveling and they quit spending money and they got senior citizen discount coffee at McDonald's. But like baby boomers today, that is not the retirement they want.
No.
And in our industry as advisors, that's not the retirement we want them to have.
Exactly.
Retirement in the past, I think, was this kind of place where you quietly waited out your end of days and didn't make any waves.
Yeah.
Today, it's this reward that the boomers have earned through years of hard work and diligent savings. And it's not going to be a small, quiet retirement. They want to have these enjoyable retirements.
Yeah.
But because of that, our whole system of saving, the whole concept of tax-deferred savings, IRAs and 401ks and 403bs, was all built on this promise or this belief that our tax rates in retirement will be dramatically lower than they are today.
Yes, 100%.
But this dual pressure of baby boomers and the generations that follow wanting to maintain their lifestyle in retirement, so they got to maintain their income, and the government pressures of needing more revenue, just to me make it seem unlikely that tax rates in the future for us are going to be dramatically lower than they are today.
Yeah, there's just no way.
And so that's why tax diversification becomes important, because we got to have some kind of hedge against the risk that our taxes in retirement aren't lower.
Yeah.
I want to make sure our retirement approach is still okay. And that's why 2025, year of the tax-free conversion. You heard it here.
And if I think I ponder this from time to time. I think the Roth is such a great deal that I'm surprised. I think if somebody tried to originate the Roth now, the whole concept, it would probably get laughed out of Congress, right? And so one other thing that you hear from time to time, like, well, could they actually tax into those accounts? And I think that the political pressure would be too hard. So anything, this is just me speculating, anything would be on stuff going forward, but we don't know.
Yeah.
But so that makes the Roth a huge opportunity.
The government is a little dual personalitied on the Roth. On the one hand, they do not like, especially wealthier savers, amassing these tax-free fortunes, as the government would say.
Yep.
On the other hand, they love that the revenue comes in today.
Yep.
So we saw during Build Back Better where they were really looking to limit the ability to do Roth conversions for higher net worth Americans. On one hand, wow, that hurts our clients. On the other hand, that provision was going to take place in 10 years. And they were going to use this fire sale on Roth conversion, all that immediate revenue, to offset costs in the rest of the bill. So I think the risk to Roths is not that they end up changing the tax status of dollars in those accounts. It's that we'll find 5 or 10 years from now that wealthier Americans just cannot get money into Roth accounts.
Okay, so with that being said, let's talk about what an advisor should be doing now. So 2025, it's going to be a huge year for tax planning.
Yep.
And you know what you just said about the Roth, and that really just, you have to educate and you have to know, because this is complex, and you can do a lot of helping to your clients, or you could have them miss opportunities, big opportunities.
I think the key message is, on one hand, we can celebrate that tax rates are going to be hopefully lower for a little bit longer, but we got to leverage that gift to plan for the future when we know rates are coming up. On the other side, we have to uncover these other revenue generators for the government and make sure our clients aren't overpaying on things like IRMA fees and other kind of tricky taxes that we can help them prevent against. And I'll tell you, from talking to a lot of client audiences, there does seem to be some positive feeling and elation on taxes, but people are very worried once you start telling them about IRMA and these other government fees, that there are all these different surcharges that are going to come after their paycheck.
They need to know. So with what are you seeing? You're talking to advisors all the time. Any big mistakes you're seeing out there?
Only just letting off the gas pedal on taxes, feeling like, let's just see what happens with the Trump administration. But if we want to drive decision-making behavior for our clients,
yes, absolutely.
This is the best time to drive that decision-making behavior, because we know, the only year we know for certain right now that tax rates are low is this year. And so we have to get those plans started now. It doesn't mean the client has to convert all the funds now, but we know for a fact that they're lower now. We got to start those conversations, because they can convert this year at a discount. And we're hopeful we'll get a few more years at a discount, but we know the taxes are coming.
So this is where you put the gas pedal on the gift of 4 years.
Gift of 4 years.
I like
Use
that
the 4
a
to
lot.
plan for the next 40.
I like that. Okay, so some random questions for you. One thing happening in D.C. that isn't getting enough attention that advisors should be paying attention to. Anything come to mind?
It's a good question. I think the biggest thing that advisors and their clients need to remember is it is good to get excited about what's happening in Washington, some of the government cuts in spending. Everything that can be done now can be undone the next 2, 4, 6, 8 years. So we can't put all of our eggs in this hope that this problem is solved, because future administrations are just going to go right back to spending the way we spend. We forget that we actually had a balanced budget in the 90s. And now we're sitting on a $36 trillion debt that has been built up by these multi-trillion-dollar deficits year after year after year. It's just hard in government to make anything permanent.
You think we could sell enough gold cards to?
I saw a statistic that there's a GDP, gross domestic product, but there's also GGP, gross global product. And right now, the U.S. debt is equal to about 40 days of gross global product.
That's gross.
Which means all we've got to do is get every human in the world to work for 40 days and give us all the money to pay down our debt, and we'll be fine.
That seems fair.
We're almost there.
It's like a Ponzi scheme. We get everybody in the world to send us $1.
That's right.
And for every day.
For every day. The Russians and the Chinese are already on board.
Bless their hearts.
Yeah.
All right, here's a rando. Is there any chance that the Congress does something proactive for retirees?
Yeah, that's a great question. To be fair, keeping tax bracket rates low is proactive for retirees. Making Social Security income non-taxable is good for retirees. I think the challenge is long-term, the need to drive revenue.
Yeah.
So it's like we're going to get all these little gifts, but they're not going to be gifts that we can have confidence will last forever.
Yeah.
I personally get my Social Security statement in the mail once a quarter and immediately shred it. What does that matter? So I think the most important thing for our clients right now is to make sure that they have diversification, not just when it comes to market risk or income risk, right? Yes, we want you to have a mix of equities and fixed income so we're prepared. And yes, we want to make sure you have some guaranteed income with your variable income so we're prepared. Yep. But if all of your assets are in these tax-deferred vehicles, you have no tax diversification and you're not prepared for things to change.
Yep.
It's kind of the final piece. And I actually think that's important because it can be hard to talk taxes and government and politics and what's going on. It can feel like a downer. Like parts of this conversation, you're like, oh, we're in
I'm
so
sad.
much trouble. But there are things we can do. There are strategies that can help. So I think
Yes.
the key is to help our clients understand doesn't have to be big and scary. The same kind of diversification you're already used to implementing in the rest of your retirement approach, we can just apply here on taxes and be okay.
I like it. So I have two brothers that are huge advisors.
Yeah.
And one of them, a shout out to my brother Dave, he would tell clients that tax deferral is just procrastination. And I used to think that was dumb. And now, Dave, I apologize. I thought it was dumb and I was wrong.
Pretty
I
good
was like,
advice.
It's pretty damn good advice, and you were like way ahead of the curve on that one, because that was a decade
Yep.
or more ago. So you're an advisor.
Mm-hmm.
You're out there right now. What are you hitting this year? What should be the message you're hitting home? What would you be focusing on?
Mitigating this legislative risk is obviously a big piece of that.
Mm-hmm.
We're coming off an election. We've had very volatile times in Washington over the past couple of years. This is the time to say, look, I like to say, as your advisor, I don't want you dodging bullets in retirement.
Yep.
Our job as financial professionals, we are not in the hope business. We are not trying to give our clients hope that they'll be okay and their retirement approach will be okay. We are in the confidence business. And so we have to help our clients have confidence that no matter who is in power in Washington, they can live the retirement that they want. And that means we're not dodging bullets. We're getting some of these assets out of the line of fire so that we don't have to worry what's happening in Washington.
And I love the fact, one of the things that I love about this industry, and we talked about it at the very beginning, is that the rules are always going to change.
Yeah.
That part stinks in a way, but at the same time, people are always going to need assistance.
Yeah.
They're always going to need advice. They're always going to need someone to interpret this. And there will be those that attempt the do-it-yourself route.
Yep.
And I would just say bless your heart, because this world just gets more and more complex. And I think one of the problems with do-it-yourselfers is you look at it and then it feels a little too complex, so you pass. And every year, I think about this now as I'm getting older, every year that when I was younger I didn't take advantage of the Roth is going to bite me in the hiney.
Bite you in the bottom, yeah.
Yeah. So, Becky, we're going to land this plane.
Okay.
So, final thoughts. For somebody listening to this, the beginning of March of 2025, by God, that'll be on Monday. Today's Friday. That'll be on Monday. So between now and then, who knows how many
New
executive
things could
orders come
happen.
out,
That's
right?
right.
Give us some advice. Give us some guidance.
Well, I think we need to understand that we can talk to our clients about what's happening in Washington without being political. So I think the final message is, if you are an advisor and you're listening and you're like, gosh, I don't, when an audience is in front of me or I'm meeting with a client, I don't know where they stand politically. I've been told my whole life, don't talk politics. You can absolutely talk about these risks without coming down on the side of Democrats or Republicans. And I say a lot to clients and audiences, here's the truth. The number one thing driving legislative risk in your retirement approach, the risk of rising taxes, the risk of Congress changing the rules, it's not actually whether Democrats or Republicans are in the White House and in control of Congress. It's important, but it's not the most important thing. The most important thing driving this risk in retirement is that in America, we have elections every 2 years. So every 2 years, we have new government. And I'll say, we need to find a way that we don't have to navigate and manage your retirement approach through the next 10, 15, or 20 administrations. We have to find a way that we can get some of your assets out of this crazy mix, out of the line of fire of Washington, so that no matter who's elected in the future, we know your retirement's going to be okay.
Yep. That is great advice. I wish we could go, this is naive. Ready for a naive statement? I wish we could go back to when, whichever side you fall on, it used to just not be. Every 4 years you would think about that. But now it's almost like it's your football team. And it's like, oh my gosh, like for those of us that kind of fall in the middle, it's like, hey. But that is great advice. One thing you have, and I wrote it down, and I want to make sure. So if you're listening, shoot me a message. If you're watching the podcast, I'll get it thrown up on the screen. But you have a legislative toolkit.
Yeah, so I loved being at Summit One with you guys in January, kicking off the year strong. We put together kind of a legislative toolkit that has some client brochures and white papers and even videos you can use on social media and other places that just help in a nonpartisan way tell this legislative risk story to your clients so that we can motivate them to having some tax action. So if you put up the QR code or if you comment, we'll shoot it to you.
Boom.
We'll send you this toolkit, and it's full of some really great resources that frame up IRMA, frame up taxes, just help your clients understand what's happening.
I love it. Becky, thank you so much. That is going to be our wrap point here. So, Becky, thank you for being on the show. You've been on, I think, like
I know.
4
I
times?
love it every time I'm in town. Always love coming.
I love having you on
And
here.
Washington always gives us something new to talk with advisors about and help prepare our clients for. So
Next time I will have some Washington trivia.
Love that.
You'll probably know the people or have
Maybe.
been there. I mean, that one time we had a conversation of who was the best looking president.
For next time. Join us next time for hottest U.S. presidents.
We'll have, there would have to be actually some categories there of in office or
At
ever.
any point
Yeah.
in their history.
So with that being said, this is the end of our conversation today. Thank you for being here. If you have a question that you would like to ask or a topic you'd like me to cover, please shoot me that in a message. If you have any feedback, I love criticism, all kinds, constructive, non-constructive. I like to read them all. If you do want the toolkit, though, that legislative toolkit, if you're watching, you'll see the QR code. If you're not watching, just send me a message. I'll get it out to you. And then lastly, of course, subscribe. Like, subscribe, follow the show. That way, anytime we drop an episode, you get that information right off the bat. So, Becky, thank you for being here again.
Thanks for having me.
We'll see you all later.